right, well, welcome everybody to what is a Wilson Weekly anniversary. This is, I believe, officially episode 52, Doc.
Well, happy anniversary, Graeme, and I'm sorry I didn't bring flowers, but perhaps I'll remember next week, but I'm not good on anniversaries. Look, isn't that great? A year, and what a year it's been, and perhaps we can talk about the year that was when we finished today's latest data, and we've got some interesting data today.
And you know, it'd be better than flowers. I'm not really a flower man, Doc. I think I think we'll just summarise the 52 episodes that have been and the reality of it all. So I prefer the data anyway. So don't worry, I'm not upset that there's no flowers.
Okay, it made me feel good. So with all that, shall we push the go button and
let's rip straight into it this week?
Let's do it. Yeah. Of course, we're at the end of the month, Graeme. Not only is it an anniversary for the podcast, our podcast, but we're at the end of the month. First month of spring has passed us by. Interesting month. I think that we're seeing a settling of the market now. No surprise, because we've had some really strong results this year so far. And although prices are still rising, and we'll have a look at the latest house and unit prices for the September quarter, hot off the press. I think that even though prices are still growing, but they're not growing at the rate that we saw a couple of months ago, a couple of quarters ago. And there's a number of reasons for that, and we can discuss that. But look, onwards and upwards, and a lot of what's happened in the market this year has certainly been catch-up energy. We, of course, fell away last year when interest rates increased for the first time in 10 years, and that all began in May. A lot of scary headlines, a lot of doom and gloom. It kept buyers and sellers out of the market, as we typically see. And, of course, we were at the end of what was a very strong post-COVID boom.
Yes.
So that market's always eased because buyer activity is satisfied. Any pent-up demand eases. And, of course, higher prices tend to sideline buyers as well. So but then we had the higher interest rate story, which kept the market a little disturbed for a few months. But interesting, and we spoke about that, and that's probably what we were speaking about a year ago, was the fact that we had in our beginning episodes or a year ago, certainly, that we had the first signs that the market was actually starting to turn. And it's a year since the market did start to turn, Graeme. So we've actually had a year of the market moving from its bottoms, from its trough, to now back to, not quite at its peak for Melbourne and Sydney in terms of peak price levels, but certainly a market that's moved forward strongly this year. So let's have a look at the latest data, shall we?
Absolutely.
Just to see what's happened over the September quarter. So as we mentioned, My Housing Market, we have a robust, rigorous in-house data modelling mechanism. We measure prices over the quarter. We get a high number of observations. We get that data from various sources. We know when we compare it to other price models that it's a reliable but the important thing is it's timely, Graeme. Here we are. It's just 2 days before the end of the month, and we're coming out with the latest data. With data that will reflect what's happened over the month when we see other models that come out. In some cases, we'll see September quarter data coming out in a month's time, Graeme, from some data providers, when we'll be releasing our October data. So I'm not sure what value that is, because we'll be talking about October, not the September quarter, when that data set comes out. But nonetheless, the latest prices still show September house prices, national house prices are rising, continuing to rise. Growth levels have started to ease. Of course, a part of that, the scenario, Graeme, of course, is that the buyers that were sidelined last year have moved back into the market. They've satisfied their demand. Similarly, sellers have come back into the market that were sidelined last year, and that's been satisfied. And, of course, we've got affordability issues that have also impacting the market. We know we've had 12 increases in interest rates since May last year. We've gone from zero zero rates now to 4.15%. Mortgage rates are now average mortgage rates are now over 8%. So even though obviously you can get lower than that, but that's the average rate at the moment, variable standard. So these things all act to slow down buyer activity, Graeme. And also the September can also be a quieter month for the beginning of spring for various reasons. Of course, this weekend we have the AFL Grand Final. There'll only be a handful of auctions in Melbourne. There's been a number of distractions for sporting events, etc., over September. And of course, we'll be moving into school holidays soon as well. But nonetheless, prices have continued to rise. But the rate of growth is just easing, still positive, but it's just eased over the first month of spring. And of course, that quarterly growth rate does include July and August data. So we are taking that data well, but and we're comparing it to the August, July, and June data of the previous quarter that ended in August. So growth levels have continued to ease. Most capitals are still reporting solid to strong growth in house prices over the year to date. And unit prices have really steadied. They've found their peak at the moment. So unit prices have been steady over the past 2 quarters.
It's an interesting one, Doc, because we've talked about this a lot over the last 51, 52 episodes, that units actually outperformed houses on average last year. You were 4.3 and 4.2 down, but units have become quite whether it was a price point versus rental return for investors or location, but you've talked about this a lot. Units really come back on the radar for homeowners and investors over the last 12 months.
Yeah, absolutely. And, of course, the comparison with houses is houses had a lot more to catch up with, as you said, because units were a stronger market, a stronger market segment prior to those higher interest rates. And or last year in total, units performed better than houses. But this year, houses will perform better than units. But the interesting thing, Graeme, is when we look, and we will in a second, at the data, to compare where houses are in most capitals compared to, or the big capitals anyway, compared to their previous peaks, which was in March quarter last year at the end of the boom, units are actually closer to their previous peaks than houses are, which just sort of backs up what we said, that there was stronger growth in units last year than houses. And houses have been catching up with units this year so far. So this is the national chart for house prices, national house prices. Of course, this is weighted average data, Graeme. So it basically is Melbourne, Sydney and Brisbane, because it's weighted on the number of sales and listings. But we've increased for the 8th consecutive quarter, Graeme. So we've had 8 monthly quarters. That sounds a bit silly, but it's the quarter of the month, the 3 months to the month versus the 3 months to the previous month, which is a very steady mechanism for measuring house prices. And you can see there that the trend's just eased off a little bit from those steep increases we saw through autumn and into winter, but nonetheless, another quarter of growth, another monthly quarter of growth, the 8th in a row. So let's have a look at the breakdowns, Graeme. Sydney up. I've also put a trend model in there to perhaps give us a sense of where the data is compared to the previous month, and when we look at the trend data for Sydney, it recorded a 0.2% increase over the month in house prices compared to the August quarter, which was the same. But Sydney house prices, Graeme, have now increased by 8.3% over the year so far. So that's compared to the beginning of the year. And Sydney house prices are now 8.3% higher. And we're looking pretty close to getting that 10% result that we've been discussing for a while now. Over the full year, up 6.3% in Sydney, but still lower than where it was, that Sydney house price in March last year at its previous peak. So it's closing in on that particular result. So it'll be a bit of a line ball if Sydney does get back to peak prices. But of
definitely
course,
not the 10% loss that was very well publicised in the headlines of the media last year, Doc. for 2023.
It's a complete opposite, Graeme. And this is another point. The closer we get to peak prices last year, the less, the peak prices of last year, the less that discount driver is of the market. And that's what I mean. Markets were catching up. Buyers were coming into the market because prices were well below where they were last year. And that value opportunity was driving, particularly the Sydney market. And the closer it gets to where it was in March last year, of course, the less value opportunities there are. And as I said, especially considering that you pay considerably more for your mortgage now anyway. So that offsets that. That's why prices growth, while still positive and still obviously a lot of positive drivers in the market, demand is well ahead of supply, very strong economy, which we looked at last week, a booming economy, wages are rising. But at the end, these factors are being offset by affordability issues. And that's why Sydney was flat. Melbourne's just gone a little bit sideways recently, Graeme. It was down by just 0.2%, so basically flat over the September quarter, up 3.4% so far this year. Melbourne's been, we thought Melbourne would perhaps perform a little bit better this year, but it's certainly been an underperformer in terms of expectations, but still nonetheless up by 3.4%. And it's 3.4% also lower than where it was at its previous peak a year ago. And you can see that trend just down on the results over the previous quarter, over the August quarter. Brisbane up again, not as strongly as it was, the Brisbane market up over the August quarter, but up by 1%. So just a little bit lower compared to the previous month, up by 7.2% over the year so far, Graeme. So a good result there for the Brisbane market. And the Brisbane market is now tracking at its highest point in history. So it's at its peak point. It's 1% higher than its previous peak point at the moment, and 5% up on the market. So that Brisbane market's just kept on keeping on.
There you go,
Graeme, and more good results there for Brisbane. And of course, as it moves above its peak, it does also have affordability issues because Brisbaneites are now paying more for property than they've ever paid before for houses. Adelaide up 0.3%, again, lower than the previous month, but still Adelaide's up 6.2% over the year, full year 7.9%. And the Adelaide market's also at a record level, Graeme, at 0.3%. Perth, again, another strong result for Perth. It actually is accelerating compared to the previous month, up by 1.2%. Perth's house prices are up 8.1%, Graeme, over the year so far, and up 9.9% over the full year. So Perth's nearly achieved a 10% result over the past 12 months.
Wow.
And it's also at peak prices. As we've discussed, a little bit of reversal from Hobart there. Hobart's been a bit of a nonconformist in terms of prices growth this year, while others have been rising. It's tracked backwards over the year, but just starting to stabilise, up by 0.3% over the September quarter, which is higher than the previous quarter's result, but nonetheless down by 6.6%.
And any real key factors down there, Doc? Hobart ran pretty hard for a couple of years when no one did. Anything really driving that downturn and settlement there, do you think?
It just tends to be a contrarian market, Hobart, Graeme, for some reason. It's, as you mentioned, it's rising when everybody else is falling, and it's falling when everybody else is rising. But nonetheless, that it's still a market that's held its price through the cycles quite significantly. And even though it is down in the current cycle, it is, in a sense, consolidating the growth that it's had when other markets were falling away, particularly during the COVID period. Darwin was up, but, some good signs there for Hobart. Interestingly enough, it started to grow again, perhaps when others are easing. But the Darwin market up 1.2% over the quarter. That was an increase compared to the previous quarter. But Darwin is a volatile market because there's much smaller numbers of sales. So it tends to bounce around from quarter to quarter, Graeme. But nonetheless, Darwin's up 6.9% over the year so far. Canberra, just a steady result for Canberra, lower than the previous quarter, down by just 0.1%. But the Canberra's also been a little bit of an underperformer, up by just 0.3% over this year so far, and down by 2.1%, and well below 2.1% over the year, and well below where it was compared to its previous peak at the beginning of last year. We can see the national results there. National house price up 6.1% this year, up by 5.1% over the full year, and just about back to its previous peak point now. And that reflects those smaller markets, Brisbane, Adelaide and Perth, who are at record levels now, and that's pushed up the national price compared to where it was at its previous peak level. So it's interesting that every market, Graeme, with the exception of Hobart, is recording what you'd call pretty strong growth, with the exception of Melbourne, which is solid, and Canberra, which is steady. But those other markets, Perth 8%, Adelaide 6%, Brisbane 7%, Sydney 8% so far this year. So they're pretty fair results, I'd suggest. And, the Brisbane, Adelaide and Perth markets are all tracking at record levels at the moment. So it's been really a big year in property, even though we're seeing some steadying in growth levels. Nonetheless, these markets are looking at closing in or certainly going to be close to double-figure results by the end of the year. I mean, Perth, Adelaide, Brisbane and Sydney will maybe all of them, if not at 10%, will be pretty close to 10% growth so far this year. And I think, that's a pretty good result for homeowners. And as you said, it really flies in the face, a lot of those comments. But look, interest rates eventually slow the market down. A lot of that pent-up demand has been released from last year. And, of course, higher prices also tend to sideline buyers. And given 10% growth, it's hard to keep up with that in an environment where we have higher interest rates and also higher inflation, Graeme. So people are having to pay more for costs, but still
pretty hard, Doc. If you're trying to save a deposit and the market's moving 10% and cost of living's gone up 5 or 10%, it's pretty tough. And rent is that, but geez.
That's right.
Pretty tough.
And that keeps first home buyers out of the market, particularly those higher rents. So national house prices, as we've discussed before, Graeme, they've steadied over the last 3 quarters. The last 3 months of quarterly growth has been steady for units, but it was quite strong through the autumn period, as you can see. But units are still well above where they were generally a year ago. Sydney eased by just 0.4%. And because the national house price really does capture mainly Sydney, Melbourne and Brisbane when we're looking at units, because they have a significant proportion, particularly Sydney, of unit sales and listings, that has an impact on the national price. But Sydney units are still up 4.7% so far this year, up by 2.4% over the full year. And Sydney units, Graeme, are just below their previous peak. So they're closing in on their previous peak of a year ago. And that's, again, as we explained before, because the units had a stronger period of growth through the boom and generally last year anyway, which means that they're closer to their previous peaks than houses. And that's why growth is consolidating now in unit markets, because they are closing in on those previous peaks, and therefore those value opportunities are diminishing. Melbourne up 0.3%.
Sorry, Doc, I'm still on the house price slide. I think are you on units now?
Holy moly. Yeah, there we go. Wrong slide. Brilliant. Sorry about that, mate. So there's our unit deck. Well, maybe we're having 52 episode fatigue in some way, but I doubt it. But, there we go.
We won't even cut this as a blooper. We'll leave it for everyone.
There we go. So there we are with the chart trend for units. You can see how that's leveled off, Graeme, but after very strong growth earlier in the year. And that's the data I was discussing in regard to the actual numbers. Sydney down 0.4%, so reasonably steady, up 4.7% this year so far, and the full year up 2.4%. Still 1.8% below the previous peak, but that is closer than houses, if you remember. And the trend is just downwards compared to the previous month. Melbourne prices up just a slightly 0.3% for units. Only up 1% Melbourne units this year so far, and just 5% full year. Melbourne units have clearly continued to underperform, and they're still 6.2% below their previous peak. Brisbane just steadied a little bit unit growth over September, but the units in Brisbane, Graeme, are up 7.8% this year so far and up 10% over the year so far. Brisbane units have really gone off. Very strong result there. In Adelaide, which has a smaller unit market, so we need to take it with a grain of salt, but nonetheless, Adelaide units have performed very well, 11.9% this year so far, 13.8% over the full year. But I think Brisbane's the standout there, given it is a strong unit market, and it's up by double figures over the full year. Perth also, again, a small unit market, so this can be tend to be volatile, and it can change according to the mix of property price types, but up 7.2%. Hobart, again, similar to houses, down over the full year and over the year to date. And Darwin up 5.2% over the year so far, up slightly over the month, the quarter to September compared to August, and the trend downwards. Canberra just picked up a little bit compared to the previous quarter, up by 0.3%, but steady results for the Canberra unit market after what's been really spectacular growth over the last couple of years. And as we said with the national market, just steady, down by just 0.1% over the September quarter. This year up 4.2%, full year 2.9%, dragged down a little bit by that Melbourne result, and just 0.6% below the previous peak. So that's the latest data for houses, Graeme, and units for September. Just continuing the trend of easing data, but something we should be, fairly accepting because of those factors we described. So let's have a look at we looked at that in depth. House and unit price market changes over September, latest data. Let's have a look at what happened last weekend, Graeme. Interesting weekend last weekend. It was our Super Saturday of auctions. Typically, we see a surge in auction listings. Probably didn't get as big a surge as we normally get on the pre-grand final Super Saturday. It's because agents avoid, in Melbourne particularly, the AFL Grand Final, so they don't schedule auctions for this coming weekend. There'll only be a handful. So we get a front-end loading of auctions. But it was interesting because we've seen some easing in auction clearance rates over September so far, Graeme, which again is what we always say. Auction clearance rates are a great forward indicator of what's happening in the market. And once again, they've proven that when we've seen some still growth, but some moderating growth in prices. We've seen some moderation in the full September data to date. So, and I think part of that, but what we did see was actually markets rebounded, Graeme. Was actually, we were expecting perhaps more moderating results, but in fact, the markets bounced back quite well over what was a big listings weekend. And that's been part of, I think, why it's dragged markets downwards a little bit. Those clearance rates easing has been, we've seen some very, very big numbers of auctions in Sydney and Melbourne, particularly Sydney over September so far. We've had, virtually weekend after weekend, the highest number of listings for the year so far. And again, we saw that in Sydney on the weekend. So certainly buyer depth was going to be challenged by all those extra listings, but it wasn't, Graeme. It shows that buyers' depth are held up, and it's still very much a seller's market on the clearance rate. So here they are, 875 auctions in Sydney, Graeme, which is the highest number for the year so far. 75.9% clearance rate. That's the best result for a few weekends. Very good result there, pushing back up towards that 80 number, well ahead of where it was the weekend before and well ahead of where it was the year before. Melbourne also big numbers, not as big as we typically see in Melbourne pre-grand final. That Melbourne market has just started to maybe have a little bit of a ponder, easing slightly, but nonetheless a good result for Melbourne, 70.5%. Again, a big number of auctions in Melbourne, the highest for the year so far. 70.5% clearance rate, bounced back from the previous weekend. So some good signs there in the Melbourne market. Brisbane, we didn't get a lot of listings coming through for Brisbane. That can tend to make that market a little volatile, but still a good result, 60% for Brisbane. Adelaide, of course, which is an AFL city, it had higher numbers of auctions and a bounce back to its 80% clearance rate that we're used to seeing from Adelaide. So, and Canberra down a little bit, steady in terms of numbers, down a little bit with its clearance rates, but that Canberra market as we've also discussed, has been moving a little sideways lately. So there's the trend for Sydney, just holding up. Certainly not at those very big results that we saw at the end of autumn when we had those 80% clearance rates, Graeme. But, of course, that's boom time results, but still holding quite well and certainly still a seller's market well above 70%. Melbourne just sliding so far over September, under 70%, 69%. Still call that a seller's market, but that Melbourne market, as we've seen with prices, has just started to ease over the past month. Brisbane holding at those levels, certainly below where it was at its peak during autumn as well. And Adelaide also producing strong results, and Canberra down a little bit. So those auction clearance rates, Graeme, are available every Saturday night on my LinkedIn channel. They're the capital city results, and Sunday morning we have the full national results. We also always promote, Graeme, at the end of the show, our podcast, the little special show bag gift that we have for our listeners, viewers, and that's our app, which gives you, which helps you monitor what's happening in the housing market in real time. This app will tell you what the current asking price, median asking price, high price, low price is for every suburb in Australia, Graeme, as it is right now. So every suburb in Australia that has a listing is recorded in this app. And you can look up the state, you can look up the capital city, and then look up its suburb. And it will tell you, as I said, the high, the median, the low for prices. Also for rents, it will tell you what the current median rent, high rent, and low rent is. It'll also give you the number of listings, okay? So number of properties for sale and for rent. And you can also filter it for houses, units, and townhouses. And you can also filter it for the number of bedrooms. So you can look for a one-bedroom flat or a four-bedroom house. It's a very useful little tool. So that's the QR code for that. But it is in conjunction with Infinity and Graeme. So you have to go through Graeme when you get that link to get the password, the all-important password. So that's the end of our show for today, Graeme. Just next week, we're going to look at interest rates, October next week, interest rates from the Reserve Bank. I think it's almost a no-brainer. It'll be on hold again. Nothing's really changed this month. The latest inflation data, we'll have a look at that. That will be interesting. If anything has changed, it'll be inflation. But I'd suggest if it's changed downwards. But you never know. I think we have to have a look at that inflation data for September that comes out at the end of this month. Retail spending will be interesting. And, of course, we'll look at the latest weekend auction results. So big show today as usual, Graeme. So we'll leave it off right there, perhaps, and await our 53rd episode next week.
Absolutely, Doc. Thank you as always. Now, before we go, but Doc, I thought we'd just wrap up and thank you. It's been an absolute pleasure over. It's probably been a bit longer than 52 weeks. We've had a few weeks off here and there.
Off. Yeah, that's right. It's not over the year. It's over the year.
No. It's been about 18 months, 2 years. So, but Doc, I do remember before we went onto the YouTube version of this and COVID, if we think back, when was that? Wow, that was still a thing. And we weren't on YouTube then. And that's when we had predictions, very firm predictions of 10% crashes for 2023, which we've never had historically. What the biggest we've had is 5.5%.
Yeah, 5%.
Yeah. And we've never had 2 consecutive years in the last 40 years of a correction ever either.
We've only had 4 out of 30 years. Forever. Yeah.
So, look, I want to thank you on behalf of our listeners, Doc, for keeping things real and keeping them sane and really not so much giving our opinions, but just using the data to say, well, the data says this is the trend, this is the graph. Yeah. And I think it's important for people that do listen to us. Hopefully you get value out of this as a service to the community. Don't get caught up in the nonsense, right, Doc? Not the opinions, not the forecasts that are emotionally based and the headline grabbing. Really just use a scientific approach. And if you're not already, go and follow Dr. Wilson on LinkedIn. There's an abundance of free information. So just a big thank you, Doc, from our community and from myself. We really appreciate it. So
and everybody get onto the app. Get onto the app. You know, that's
they've got to be a client for that, Doc.
Well, that's right, of course. Yeah, but when you get it, you'll appreciate it because it's
absolutely
something you can play with all the time. just to find out what's happening in the market. But of course, listen to us every week and watch us every week, because I think, as we've proven over the journey, we're pretty well spot on, Graeme, with what we do say. Not just in terms of the market, which of course is our focus, but also the peripheral issues in terms of the economy, etc. And that's probably panned out just about as we expected. Although I think that we're probably a bit more bullish on higher rates. Now, that's a good thing. We don't want higher rates, and I know, mortgage holders certainly are happy that rates have been on hold and likely on hold again for another month. But I think the big picture here, and that's what we've been confronted with, is that not just the RBA, but central banks generally have decided, hey, we're going to live with higher inflation and higher interest rates. We're not going back to the 70s or the 90s or the 80s, and we're not going to crack the economy here and create a lot of unemployment to bring down inflation. We're going to unfortunately, we're going to take the other end of the pineapple, and that is we're going to leave inflation perhaps a little higher for longer, which they are, but we're going to try to keep the economy ticking over. And that's why interest rates haven't continued to increase, even though inflation is double what the target range for the RBA is. And, I guess models in previous cycles of high inflation would have been continuing to increase inflation until we had some clear signs, particularly from the labour market, that it was working. But our labour market is still working on 8 cylinders, Graeme, full steam ahead. No. In fact, if anything, it's accelerating. So, if there's some lagged effect, and, that's the proposition from the RBA, that it takes some time to work. We're not seeing anything yet, but the good news is that they've decided that they're not going to, continue to increase interest rates, which will cause, an acceleration. But the only risk to that, Graeme, is what happens if inflation rears its ugly head again. They're going to have to act again, and I'm not sure any tiny little increase in interest rate will have any impact on inflation if it starts to increase again. Fingers crossed that won't happen. So maybe they'll get it right, the RBA here. And is it not what they call the Goldilocks, the Goldilocks outcome? The porridge is not too hot, not too cold.
Not too cold.
Just right.
Just right.
So we'll see. All right,
I love it, Doc. It's been a pleasure, and thank you.
Thank you. Thank you very much.
We'll see you next week.
See you next week, mate. See ya.
Thanks, mate.